In 1998, Hong Kong's overnight interest rate spiked to nearly 300% in a single day. Money markets went wild as the city's financial system hung in the balance. Just a few years earlier, billionaire George Soros had broken the Bank of England, pocketing $1 billion by shorting the British pound. Now he was circling Hong Kong, a city some called the world's biggest casino, placing huge bets that he could break its currency next. The stakes couldn't be higher. Hong Kong's currency was pegged to the US dollar, a cornerstone of its economy. If Soros and other speculators succeeded, the Hong Kong dollar and stock market could collapse overnight. But what happened next defied everyone's expectations. In a stunning turn, Hong Kong fought back and beat the world's most notorious speculator at his own game. This is the story of a high-stakes financial showdown. The time Hong Kong turned the tables on George Soros, protecting its currency against a massive speculative attack. It's a tale of market panic, bold intervention, and a government willing to gamble billions to save its city. Let's set the stage. It's the late 1990s, and Asia's economic miracle has flipped into a nightmare. Hot money that once poured into tiger economies suddenly claws its way out. July 2nd, 1997. Thailand devalues the baht, triggering the Asian financial crisis. One by one, currencies across Asia crumble. The Thai baht, Malaysian ringgit, Indonesian rupiah, Philippine peso, and South Korean won plunge in value. Stock markets implode as foreign investors flee. Billionaire hedge funds, including George Soros's quantum fund, are feasting on the chaos, shorting Asian currencies and reaping huge profits. Soros himself had already made a fortune in 1992 by shorting the British pound, earning the nickname "the man who broke the Bank of England," and profited from bets against the Malaysian ringgit, among others. Hong Kong, meanwhile, was watching nervously. The city had just been handed back to China on July 1st, 1997. Its economy initially seemed more resilient than its neighbors. Hong Kong had massive foreign currency reserves, over $90 billion, and a well-regarded currency system. Since 1983, the Hong Kong dollar, HKD, was pegged at 7.8 Hong Kong dollars to $1 under a strict currency board. This peg meant that for every Hong Kong dollar in circulation, there had to be an equivalent value in US dollars held in reserve. In theory, such a system gave Hong Kong a solid defense because it had the dollars to back its currency. In fact, Hong Kong's reserves were about 7 times its money supply, an enormous war chest. But the peg also made Hong Kong a target. Why? For years, Hong Kong's inflation was higher than America's, making its currency overvalued and exports pricey. Property prices and stocks had soared into bubbles during the boom. By mid-1997, the Hang Seng Stock Index hit a record high of 16,673 points. As the crisis spread, speculators smelled blood. Hong Kong's fortunes were tied to confidence in its currency peg. If that peg broke, it would be a financial earthquake. International opinion was pessimistic. Forbes magazine famously ran a 1995 cover story titled "The Death of Hong Kong," predicting the city's decline after the 1997 handover. Now, with Asian economies collapsing, many believed it was only a matter of time before Hong Kong's dollar would fall too. Yet Hong Kong's leaders were determined to prove the doomsayers wrong. The Hong Kong Monetary Authority, HKMA, essentially the city's central bank, vowed to defend the currency peg at all costs. The peg, fixed at 7.80 Hong Kong dollars equals $1, was seen as a bedrock of stability for trade and investment. China's government also stepped in with vocal support. Beijing promised it would not devalue the Chinese renminbi, which was a fear at the time, and even offered Hong Kong use of China's vast reserves if needed. This political backing added psychological weight. Hong Kong wasn't only a city of 6 million, it had the support of the world's most populous nation. So as the sharks circled in late 1997, Hong Kong looked vulnerable, but not defenseless. Still, few imagined just how far this city would go to keep its currency stable. The coming battle would be unlike anything seen in financial markets, pitting a small government against some of the richest speculators on the planet. By late 1997, speculative sharks were tearing through Asia's economies. Hedge funds had made billions by attacking weak currencies and forcing devaluations. Malaysia's Prime Minister publicly blamed George Soros for wrecking the Malaysian ringgit. Across the region, Soros was vilified in headlines, portrayed as a predatory investor willing to wreak havoc on nations for profit. Soros's Quantum Fund and others denied any sinister coordination. Soros even claimed he only speculated against the Thai baht, not other Asian currencies. But the legend of Soros, the economic warlord, was set. Hong Kong, often called a freewheeling capitalist haven, now appeared to be the next juicy target. Its stock market had begun to wobble. The Hang Seng Index fell 23% in just 4 days in October 1997, and property prices were softening. Crucially, Hong Kong's currency board system had a known weakness. The HKMA could not freely print money. Under the currency board rules, if investors sold HK dollars for US dollars, Hong Kong's money supply would shrink, causing local interest rates to shoot up automatically. This mechanism was intended to defend the peg by making HKD short selling very expensive. High interest rates punish those borrowing HKD to bet against it. However, this defense came at a huge cost to Hong Kong's economy. When the HKMA hiked overnight interest rates from 8% to 23%, and at one point to an astounding 280% on October 23, 1997, it protected the currency in the short run, but crashed the stock market and squeezed businesses. Imagine borrowing costs suddenly tripling or worse. Companies and homeowners were hit hard. Hong Kong was effectively using interest rates as a weapon, and the collateral damage was real. Stocks plunged, and economic pain intensified. International speculators saw an opportunity. They devised what came to be known as the double play strategy. In simple terms, they attacked both Hong Kong's currency and its stock market at the same time. If they could force the HKMA to jack up interest rates to defend the currency, those same sky-high rates would tank the stock market, allowing the speculators to profit on stock index bets. On the other hand, if Hong Kong gave up on defending the currency and let the HK dollar weaken, the speculators would score big on their currency short positions. It was a win-win situation for the hedge funds and a lose-lose for Hong Kong, or so it seemed. Let's break it down more concretely. Step 1. Hedge funds quietly borrowed huge amounts of Hong Kong dollars, often for a year or more, in advance. In fact, by mid-1998, over 30 billion Hong Kong dollars in 1 to 2 year Hong Kong dollar loans had been taken out, much of it by Soros's fund and allies via intermediaries. They swapped US dollars for HKD with willing partners, like global development banks raising HKD-denominated bonds, so they'd have a war chest of HK dollars ready. This way, they locked in funding and wouldn't be at the mercy of spiking interest rates later. It cost them about 4 million Hong Kong dollars per day in interest to hold that 30 billion Hong Kong dollar position, a sizable sum, but pocket change if the potential profit was billions. Step 2. These speculators then short-sold the Hong Kong dollar. Basically, they dumped HKD for USD in large volumes, betting the HKD would eventually devalue. Normally, the HKMA would counter by buying up HKD, selling its USD reserves, to maintain the peg. But because of the currency board rules, this would drain HKD out of the banking system and cause interest rates in Hong Kong to surge. Step 3. Simultaneously, hedge funds heavily shorted Hong Kong stocks and stock index futures. They placed bets that the Hang Seng Index, HSI, Hong Kong's main stock index, would fall sharply. They borrowed and sold stocks, even engaging in naked short selling at times, which was technically illegal, but enforcement was lax. They amassed short positions in the HSI futures, reportedly around 80,000 short futures contracts among a group of major hedge funds. Now, when Step 2 and Step 3 occurred together, Hong Kong was put in a vice. If the HKMA did its usual defense and jacked up interest rates to sky-high levels, that would indeed support the HKD's value, making it costly to short. But those same interest rate hikes would choke the economy and slam the stock market, rewarding the speculators' short stock positions. The speculators had engineered a scenario where Hong Kong's very defense mechanism would trigger the outcome they wanted in stocks. It was a brutal arbitrage. They profit from a stock crash caused by Hong Kong defending its currency. If Hong Kong instead tried to avoid hurting the stock market by keeping interest rates low, the HKD would be unable to maintain the 7.8 peg under the selling pressure. The currency would be forced to devalue, break the peg, and the speculators would win big on their currency shorts. Either way, the hedge funds planned to break the bank, much as Soros had done in Britain, and make a killing. As one Hong Kong official described, it was like the city was cornered. Asset markets ratcheting down every time this double play is staged. In other words, speculators could hammer Hong Kong repeatedly for profit. By early 1998, this double-barreled strategy was underway. Rumors and panic added fuel. Big investment banks and analysts put out reports predicting Hong Kong would be forced to drop the dollar peg. Each week, ahead of the weekends, traders would short the HKD, expecting some bad news or a Chinese RMB devaluation rumor to hit. Hong Kong's economic data turned grim. By mid-1998, the economy was contracting, property prices were plummeting, and confidence was evaporating. In July 1998, GDP figures showed Hong Kong's economy had slid into recession. The first quarter GDP was revised to -2.8%. The Hang Seng Index that summer was barely half of its peak a year prior. Now we zero in on Soros's strategy, often dubbed the double play. It's mid-1998. George Soros and other hedge fund titans are executing their plan in Hong Kong. They've shorted the currency and shorted the stock index, setting a trap for the Hong Kong Monetary Authority. They wanted to create a no-win scenario for Hong Kong's financial chiefs. Hong Kong's currency board system, while robust, had that quirk we discussed. A tiny monetary base which made interest rates ultra-sensitive to capital flows. The speculators understood this perfectly. They knew that selling even a relatively small amount of Hong Kong dollars could send overnight borrowing rates skyrocketing. In October 1997, it took only a wave of selling to force rates up to 280%. If they could replicate that pressure at the right moment, stock prices might free fall. Hong Kong's initial response earlier in the crisis had been to play defense with interest rates. Each time speculators attacked the HKD, the HKMA dutifully bought up Hong Kong dollars, using its USD reserves, and let interest rates leap to punish the shorts. But this was like using poison to fight poison. It hurt speculators, but also hurt Hong Kong's own investors and economy. The stock market tumbled 60% from its high by August 1998, and property values fell by half. The pain was real. Businesses struggled with expensive credit, and ordinary people saw their wealth shrink. By August 1998, the pressure cooker was at maximum. The speculators were betting that Hong Kong couldn't stomach much more pain. International commentators were openly questioning how long the peg could hold. Speculative capital had raised the cost of shorting HKD by a bit, with interest premiums. But these hedge funds treated it as the price of doing business. They were convinced Hong Kong was a sitting duck. Either the market would crash or the currency would crack. Perhaps both. Hong Kong's officials watched this unfold with growing alarm. Joseph Yam, chief executive of the HKMA, and Donald Tsang, Hong Kong's financial secretary, were the two men in the hot seat. Both were staunch believers in free markets. Hong Kong prided itself on laissez-faire policy, rarely intervening directly. Yet they suspected what was happening went beyond normal market forces. Yam would later argue this was market manipulation, not mere sharp-eyed arbitrage. To them, the hedge fund's double play was a deliberate, coordinated attack exploiting a weakness in the system. Still, intervening directly in the stock market was unthinkable to many. Free market economists like Milton Friedman were aghast at the idea. Friedman even said Hong Kong's leaders had simply gone crazy for considering such moves. The US Federal Reserve's Alan Greenspan gently admonished that trying to jack up their stock market was not wise. The world expected Hong Kong to suffer in silence, or at most tweak interest rates and tighten regulations. No one expected what came next. The breaking point came in early August 1998. Hong Kong's markets were in a tailspin. On August 13, 1998, the Hang Seng Index closed around 6,660 points, a heartbreaking drop of nearly 60% from its peak the previous year. Panic was in the air. Rumors swirled that China might devalue the yuan, or that Hong Kong would abandon the peg over the coming long weekend. Some people even started pulling money out of banks, fearing a currency collapse. At this juncture, Donald Tsang and Joseph Yam knew they had to make a fateful decision. If they did nothing new, Hong Kong's currency and stock meltdown could feed on each other and destroy confidence completely. By now, The double play was blatant. Huge short positions were sitting in both the currency and futures markets, effectively dangling a noose for Hong Kong's economy. Behind closed doors, Zhang's team debated breaking with their free market principles. The idea on the table: have the government directly intervene by buying stocks and futures in massive quantities, something totally unprecedented for Hong Kong. It sounded heretical. Wouldn't that be rigging the market? Could a government really beat Wall Street titans at their own game? And what if it failed? It could exhaust Hong Kong's reserves and still lose, leaving the city bankrupt and humiliated. But the alternative looked worse. As financial secretary, Zhang later said, at the height of the crisis, it was a matter of survival to preserve local confidence, protect the integrity of the linked exchange rate, and restore fairness to the markets. In other words, survival greater than ideology. Hong Kong's very future as a financial center was on the line. On the night of August 13, 1998, the decision was made. The Hong Kong government would go rogue on free markets. It would use the public purse to directly fight the speculators. The plan: buy. Buy stocks, buy index futures, buy anything necessary to prevent the collapse the hedge funds were banking on. Essentially, Hong Kong was about to give the hedge funds a taste of their own medicine. Joseph Yam and his team also devised some tactical fixes to the system itself. Unbeknownst to speculators, the HKMA had already pulled a clever maneuver in early August. To counter the hedge funds' initial selling of HKD, the government secretly shifted some of its fiscal reserves from USD to HKD, injecting liquidity so that interest rates wouldn't spike as expected. This surprise move meant the speculators' early August attack misfired. The expected interest rate shock didn't materialize as badly as they hoped. But more was needed. Now they were going to tackle the stock market side of the battle head-on. August 14, 1998. Hong Kong's government shocked the world. Donald Tsang, wearing his signature bow tie, and HKMA chief Joseph Yam effectively declared war on the speculators. They announced that the government would intervene immediately and decisively in the stock market. In simple terms, Hong Kong's strategy was, if you're going to short our market, we're going to buy and drive the prices against you. That day, the Hong Kong government started buying stocks, a lot of stocks. Using the exchange fund, the pool of reserves meant to back the currency, the HKMA began massive purchases of shares in Hong Kong's largest companies. This was a stunning break from tradition. Hong Kong had always preached non-intervention, and now the government was the biggest player on the trading floor. As one local paper called it, this was the gamble of the century. Over the next days and weeks, the government poured about 118 billion Hong Kong dollars, 15 billion US dollars, into Hong Kong's stock market. To put that in perspective, that was around 18% of its entire foreign reserves, nearly a fifth of the war chest, thrown into the fight. With that money, the government snapped up shares of all 33 companies in the Hang Seng Index. It didn't cherry-pick. It bought across the board to lift the whole market. By the end of August, the Hong Kong government became one of the largest shareholders in some of the city's most famous companies. For example, it owned about 8.8% of HSBC Holdings, one of the world's largest banks. It took over 10% stakes in blue chips like Chung Kong Holdings, billionaire Li Ka-shing's flagship property company, New World Development, and Swire Pacific. In many other major firms, from Hong Kong Telecom to China Telecom and CITIC Pacific, the government quietly accumulated 5% to 8% positions. Essentially, the state was buying pieces of the crown jewels of Hong Kong's economy. This was unprecedented, a quasi-nationalization of portions of the stock market. Critics screamed that Hong Kong's free market credibility was dead. The government countered that it had no choice. It was a one-time extraordinary measure to prevent market manipulation from destroying the city. Joseph Yam argued, free markets do not mean markets can be freely manipulated. In other words, if speculators were bending the rules, Hong Kong would step in to even the odds. Traders in Hong Kong were astonished. Suddenly, whenever short sellers dumped shares, a mysterious big buyer would gobble them up. Share prices, which had been in free fall, started stabilizing and even rising. Volume exploded. On some days in mid-August, trading turnover hit record highs as the government kept buying and speculators kept selling. One such day was August 28, which saw 79 billion Hong Kong dollars in trading, a historic surge. It was like a heavyweight boxing match in the markets. Hedge funds would throw a punch by selling a huge block of stock, and the HKMA would counterpunch by buying it. Bit by bit, the speculators realized they weren't just up against panicky investors anymore. They were up against the deep pockets of a government renowned for fiscal discipline. Hong Kong didn't stop at just buying stocks. The authorities also intervened in the futures market, buying index futures contracts to prevent a plunge in futures prices. By supporting the futures, they indirectly supported the expectation of where the stock index would be. They also tightened rules on short selling, requiring quicker settlement of trades and making naked shorting stocks you haven't actually borrowed, much harder. They were closing any loopholes the speculators had exploited. Internationally, the reaction was shock and anger. Western financial leaders criticized Hong Kong. The Wall Street Journal and The Economist tutted that this was a grievous mistake that would scare investors. But Hong Kong's bold stand also got some begrudging respect. Even Alan Greenspan, a decade later, admitted that Hong Kong may have made the right call in that desperate moment. And one by one, prominent financiers began to say they understood why Hong Kong did it. Inside Hong Kong, the public initially was anxious, but soon rallied behind the government's moves. Seeing the stock market free fall arrested was a relief to many investors and pensioners. In their eyes, the government was heroically defending the hometown market from foreign predators. Still, it was a tense period. No one knew if this gamble would truly pay off, or if the speculators would find another angle to press.